Exercise 20-29. We're going to journalize the transfer of costs in a process costing system, and then we will journalize the sale of the manufactured products. So Hartley Company has a production process that involves three processes. Units move through the processes in this order: cutting, stamping, and then polishing. So I modified a screenshot, I modified a PowerPoint slide and I have a screenshot here. So here we've got cutting, and then stamping, and then polishing, just like it says up here. The company had the following transactions in November. So we could look at these transactions in here, but we really don't need to because they list them individually right here. So in the first transaction, it says cost of units completed in the cutting department. So here's the cutting department. So when some units are done, they need to leave the department. So how do they leave the department? They credit the department. I've put the $17,000 of costs transferred out just to kind of show you what's going on. So I'm going to skip the debit. I'm going to go to the credit, and that's work in process cutting, 17,000. And where did they go to? They went to the second department, which is stamping. And when they come in here, they are on the debit side. So stamping is the debit account. Next, number 2, cost of units completed in the stamping department. So we got 30,000. Copy and paste. And now notice it said they're completed in the stamping. So they're leaving the stamping. So that's the credit account. So stamping is being credited. Of course, debits have to be listed first. And then where are they going to? They're going to the polishing department, which of course it says up here. Polishing. And then costs of units completed in the polishing department were 35,000. So they're leaving the polishing department. So the polishing is being credited. 35,000. Copy and paste. And where are they going to? They're going to finished goods. So finished goods is increasing on the debit side. Finished goods. There you are. And then finally, we've got sales. $50,000 of sales, so we can plug that in. Copy and paste. Do not record the costs. That will be recorded in the next step. So COGS and finished goods going down will be the next step. So we have to list sales. So we're either getting AR or cash. Unfortunately, it doesn't tell us here if it's AR or cash, so we probably have to go up here. It says sales on account. So AR is increasing, accounts receivable is increasing, and then sales revenue is increasing, also known as sales. Just to remind you about the accounting equation, revenue increases on the right side, and accounts receivable, an asset, would increase on the left side. Check answer. And then finally, cost of goods sold is 80% of sales. So 80% of sales, so you just take 50,000 times 0.8 gives us 40,000. Okay, and then so what's going on is the goods are leaving finished goods. So finished goods has to be credited. Finished goods inventory is lowering, and where do they go to? They go to cost of goods sold on the income statement. So COGS is increasing. And that's it.